Welcome back, traders and investors. I'm Nick from Parabolic Financial. We're continuing our series on how the news can affect stocks. Today's topic is stock splits and what you need to know about them. You probably know that a share is partial ownership of a company. A company's board of directors decide on how many stocks to issue. So that'd be a total number. It doesn't mean that they've hit that total number, but they decide on the maximum, okay? The number of shares issued by a company is referred to as the outstanding shares. You might have heard OS for short. This number could be as low as 1, although if it's listed, it's got to be somewhere in the hundreds. I can't remember the number exactly. The upper limit is the company's published maximum number of authorized shares, which we talked about just a second ago. Each company needs to decide on this number. Typically, the OS for a company is in the millions, but it could also be in the billions. A stock split adjusts the number of outstanding shares by either increasing or decreasing the OS by a set multiple. There are two types of stock splits. The first is when you have an increase in the number of shares in a stock. That's called a stock split. The second is when you have a decrease in the number of shares, and that's called a reverse split. So let's look at the regular stock split first. Again, a regular stock split increases the number of shares in a company. Let me give you an example. Let's say a company has an OS of 10,000 shares. The company then decides to create more shares out of the shares that already exist. One example that recently happened in the last quarter was Apple. Apple had a stock split where the company decided that anybody who owned any of the stock or any stock that exists would become four stocks instead of one. If you owned one Apple stock and it was trading at, let's say, $400 pre-split, you owned equity in Apple at the amount of $400. After the split though, you're still gonna have $400 of equity. It's just gonna look different because now you're gonna own 4 Apple stock that are each worth $100. So remember, you had 1 at 400, now you have 4 at 100. You still have the same total equity, it just changed its representation of that worth. There's a number of reasons for a stock split. Maybe a company wants the stock to be at a psychological price that people would be willing to buy it at. Consider Amazon. It's trading right now at an average of around $3,300 a share. If you want even one share of that, you have to have enough capital to buy one share. And if you're a retail investor with not a big portfolio, it might be unrealistic for the general public like you to buy that stock. Thus, a stock split enables more people to buy into the company since it's not only at a lower price, but also because there's more shares available to buy. Well, why does that matter? Well, it increases the total amount of shares that the equity trades with each day. So let's say during the day there's $100 million worth of shares trading hands. You'd still have the same $100 million worth of shares, but you'd have 4 times as many shares trading hands if you use the Apple example. Maybe you've heard the word liquidity. Liquidity refers to the ease at which an asset or security can be converted into ready cash without affecting its market price. Thanks Investopedia for that definition. A regular stock split increases the liquidity, which in turn can decrease the volatility of a company's stock, making it harder for the stock price to rise and fall significantly with a set, say, 100 share trade. All right, now that we've got the regular stock split figured out, let's talk about a reverse split. It's basically exactly opposite of what a regular stock split is. The OS in the company is gonna decrease as well as liquidity. A reverse split is generally done by companies that need to maintain compliance with the exchange that they exist upon, like say NASDAQ or the New York Stock Exchange. There's minimum listing standards to remain listed on these exchanges. Basically, what you need to know is that a company is probably going to be in danger of being delisted or removed from a major stock exchange if they don't meet a minimum requirement, including a $1 share price. Companies under $1 a share are given a window of time to fix their low stock price. If they don't have substantial news or changes to their company that can attract new equity or buyers, their choices are basically to delist and be off the New York Stock Exchange or NASDAQ. Where they go is they become an OTC stock, or they have to do a reverse split, which increases the price of their shares but doesn't change their overall market cap. Okay, let's go back to the Apple example that I gave you before, and let's say that for whatever reason they wanted to do a reverse split. So you've got 4 shares that are worth $100 a piece. In a reverse split, it just goes the opposite of what we talked about before. Let's say they did a 4-for-1 reverse split. Your 4 shares become 1 share. Those were worth a total of $400 over here, 4 at $100 a piece. Now you have 1 share and it's only worth $400. So it's still the same total equity. So companies that are doing a reverse split, they decrease the number of total shares that are being traded at any time because there's less shares that can be owned. This allows for a redistribution or a change in the price of securities that are exchanged in the company. Generally, when a reverse split is about to happen, there's a change in stock price. So this is kind of the psychology behind this stuff. People like to play these buildups in the split in multiple ways. If there's a sentiment such as the stock possibly being worth more after the split, people will likely invest more heavily right before the split and drive the price up. After the split, maybe there's a potential that the stock price may fall in this given scenario as people take profit. When companies have determined that they need to split, whether it's either a reverse or regular split, increasing or decreasing their outstanding shares, they have to release this information to the market in the form of a news piece. So you're going to see that. They also have to file with the SEC. Depending on the health of the company and the reason for the split, this news can have minimal to high impact upon the stock price leading up to this split. For more information about the effect of news on a company's stock price, watch our video on news pieces. So the real question is, why the heck do you care? Why is this valuable information for you to know? Well, if you've invested in any penny stocks, these are stocks that are usually under about $5. These are close to that $1 a share minimum bid price, right? If they fall under that $1 a share for too long, they're going to be in danger of delisting. Many times these companies will file with the SEC or one of the exchanges and get an extension, and usually that extension is 180 days. When they're reaching close to that 180-day extension period, it's less likely that they're going to get another extension. And so if they haven't met the minimum bid price for a set number of days, I believe it's 4, a company has to issue reverse split information. So when they're doing this, they're struggling to find investors who are seeing value in their company. The price is not high enough. This tends to cause the stock price to greatly decline going into the reverse split, as well as the week or 2 following the reverse split. There are, however, a few general exceptions that can change this outlook. Sometimes the company can get an extension if they can prove to the NASDAQ or New York Stock Exchange that the company has positive catalysts coming, like I said before. This extension tends to cause the stock price to rise just a little bit after that news is released. Okay, so let's say you've got a company and they don't have a lot of cash on hand. How are they going to pay their employees? Well, in this situation, they might use a reverse split to help them with that, along with something called an offering. Let's look at how that might work. So you've got your company, they were out of compliance, under $1. Now let's say they multiply their stock price by 4, but decrease the number of shares outstanding by 4, okay? So now they're in a situation which is called a low float. So there's not a lot of stock in the market to be traded. Maybe they release some positive expectations that are very far out, but because of the positive sentiment that can be created from that news, they can pop their stock price up. And at the same time, when they're at a higher level, they can do what's called an offering. Now, an offering is simply they're releasing more shares into the market to be sold. Those shares aren't owned by anybody, so that money goes directly into the company. They're able to pay their employees, but what that does is it decreases the equity for everybody who already owns equity in the company. Let's say they double the number of outstanding shares, and let's say you own some portion of the company and there's this number of outstanding shares. Well, if they doubled that number of outstanding shares, you still only have this number of shares. Man, the percentage of the company that you own is now decreased. So most long-term investment firms know that these are possibilities. So a lot of times they will start to sell out of a stock prior to the stock entering into a reverse split. This will cause the stock price to greatly decline, and it will be easily controlled by short sellers. Normal stock splits tend to cause the stock price to rise because it allows for more demand to access the stock. So remember our Apple example, the first one, the regular stock split? Yeah, there was greater demand right at the end and you saw a rise. This may start to become less relevant though, now that exchanges and brokers are allowing for partial shares to be bought. Lastly, something you should know is that technicals, like what you see on a chart, the indicators and all that stuff, it's gonna drastically change after any type of split because you're changing the numbers with which these technical indicators rely. If you've watched our video on technical information and trading, then you know that there's only 3 variables that matter, and that's price, time, and volume. So it's just something to keep in the back of your mind. Your stock charts are gonna look kind of funny for a little bit. All right, thank you so much for joining us and learning a little bit more about how stock splits can affect a stock. Either increasing the number of shares, decreasing the number of shares, and some pitfalls that might be associated with these changes. I hope it's been informative for you, and there's more information to come in our new series. So stay with us and we'll see you later.